Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Just because you can doesn't mean you should. If you saw the original Jurassic Park movie, you almost certainly remember the scene where Dr. Ian Malcolm is criticizing the creator of the park for not considering all of the ramifications of cloning dinosaurs. And at one point, John Hammond, he's the architect of the park, he brags about how his scientists had accomplished things nobody had ever done before. And Malcolm famously replies, "Your scientists were so preoccupied with whether or not they could, they didn't stop to think if they should." I think somebody should maybe lock Jerome Powell up and along with his minions over at the Federal Reserve, lock them in a room and make them watch that scene about a dozen times. Because I think there is a very similar lack of consideration among the brain trust at the central bank. So today I want to talk a little bit about interest rate policy. And, this is a precious metals show primarily. And when you understand what the government and its central bank are doing to your money, that really is the case for precious metals. The reason that we need gold and silver in this day and age primarily is because the government, along with its central bank, using its central bank, is constantly devaluing your money. The fiat money system run by the Fed is an absolute disaster. It is stealing your purchasing power. It is stealing your wealth. So you want to have real money. You want to have gold and silver. And I really think that Fed interest rate policy has an outsized impact on the economy in this modern age because it has kind of usurped everything else. It's the go-to, right? Monetary policy is how they try to fix things or cover up things and stimulate and whatnot. And so there's all of these pernicious effects. All of this tied to this interest rate policy. So I want to talk about this a little bit. And of course, it's in the news a lot lately. The big debate is whether or not the Fed should cut interest rates. And of course, President Trump has aggressively pressured Fed Chairman Jerome Powell to cut rates. He called him stupid. I tell you what, if nothing else, Trump can insult people. The other day, he said he's an average mentally person, low IQ for what he does, Trump said. This was during a press conference during the NATO summit in the Netherlands a couple of weeks ago. He said, "I think he's a very stupid person, actually." Now, I don't think Jerome Powell is stupid. I think he's in over his head. But anybody that's trying to do that job is in over their head. Now, of course, President Trump isn't alone. A lot of people think the Fed should step on the gas when it comes to rate cuts. The markets have been yearning for rate cuts for months and months, years really. I mean, we can go back. That was kind of the theme of a couple of years ago. When is the Fed going to cut? When is the Fed going to cut? When is the Fed going to cut? And then, the Fed finally cut, but it didn't cut as much as everybody was hoping. And of course, now they're on pause. This has been a desire, this desire to return to easy money for quite a long time. So it's not just the president. There's a lot of people out there that hold this position. And it's a reasonable argument, right? CPI has cooled significantly. There are significant levels of debt in the economy. The ever-growing national debt is just one example. And this economy is addicted to easy money and really can't function in a higher interest rate environment. So the argument for rate cuts is certainly compelling. Now, of course, Jerome Powell and his supporters, they have reasonable arguments as well, right? Chief among them are worries that inflation could heat up again. But quite the conundrum, right? So you want to know what I think? I think we're asking the wrong question. Sure, the Fed can cut rates. The Fed can hold interest rates steady. Heck, the boys over at the Fed could even raise interest rates. But before we try to decide the right move for this current moment, maybe we should consider whether or not a bunch of PhDs locked in a room should be determining interest rates to begin with. So actually, let's start at an even more basic level. What is an interest rate anyway? Well, fundamentally, an interest rate is a price. It is the price of money, the price of borrowing money. It's the cost of money. So it's a price tag. An interest rate is a price tag, just like the price tag that's on the shelf, when you go to the grocery store and you look at chicken, and there's the price. That's what an interest rate is. And since interest rates are prices, well, they behave in the same way as any other price in a free market. As the demand for money increases, interest rates, that's the cost of money, they will tend to rise. And when the demand for money wanes, interest rates will tend to fall. Basic supply and demand economics. So in other words, if left alone, interest rates will set themselves based on market activity, just like every other price that's out there in the economy. So when central planners intervene and quote unquote set interest rates, it inevitably creates problems. It creates chaos. Think about it. Would you trust the government? A bunch of central planners. Would you trust them to set the price of tennis shoes or iPhones or automobiles? Imagine what would happen. In fact, we don't have to imagine, right? We have countless examples of government price controls going haywire. Inevitably, when we have price controls, we end up with either shortages or overproduction. Right? It is very rare that the central planners get the price right because they're just guessing. They don't know. Example, 1971, President Richard Nixon implemented wage and price controls, and it was an absolute disaster, right? Price ceilings intended to hold costs down led to widespread shortages, particularly meat, gasoline, and other essentials. Businesses simply weren't willing to sell at unprofitable prices, so they just didn't. When the government stepped in, they said, okay, well, fine, we're not going to sell this. Can't make money. What's the point? And so it was a huge mess. I'm old enough to kind of remember the 70s. I was a kid, but I remember the gasoline lines, and I remember just all of the talk and the fretting about inflation. Or I'll give you another example. Let's just think about minimum wage laws, right? These are price floors, and they also distort the market. They raise the pay of some workers, and if you just look at that, I guess you could argue it's a good thing. But it also lowers demand for workers more generally, especially those at the lower end of the skill set. So this leads to higher rates of unemployment. Rent controls, another great example. Go to New York City. Rent controls have caused housing shortages. So the problems with price fixing are entirely predictable, given that prices serve as signals in the economy. When you distort the signals, you distort the economy. Militaries have used kind of this strategy to confuse enemies for centuries. For example, during World War II, British civil defense workers turned around and moved signs, road signs, in order to confuse German troops in the event of an invasion. So, they would change street names or just take the signs down so that if there was an invasion, the invading forces would have a harder time figuring out where they were. And interestingly, the U.S. Army recommends the same tactic in a 1978 manual titled Tactical Deception, Part 101. Quote, change all traffic signs in the defensive area to confuse rapidly moving attack forces. Makes sense, right? Change or remove basic points of reference certainly is going to make it more difficult to navigate. Be a disaster for somebody like me. I don't have any sense of direction at all. So you start taking down signs or switching them around and stuff, I would be completely lost. And in the same way, government tinkering with the price system, those signals, those signs in the economy, they make it more difficult for markets to function. It creates confusion. Economist Thomas Sowell explained the fundamental role of prices in a foundational book, Basic Economics. He wrote, quote, "Each consumer, producer, retailer, landlord, or worker makes individual transactions with other individuals in whatever terms are mutually agreeable. Prices convey these terms, not just to the particular individuals immediately involved, but throughout the whole economic system, and indeed throughout the world. If someone else, somewhere else, has a better product or a lower price for the same product, that fact gets conveyed and acted upon through prices, without any elected official or planning commission having to issue orders to consumers or producers. Indeed, faster than any planners could assemble the information on which to base their orders." So, generally speaking, I think central planners have noble intentions. I think some of them are power-hungry, evil people, but I think a lot of them, they just want to make the world a better place, right? We want to get in there. We want to fix things. We want to control things. They want to eliminate unfairness or right a perceived wrong. But in effect, for all of their good intentions, they obliterate these important signals. They take down the signs, and this causes chaos and confusion. And inevitably, we end up with misallocation of resources. The economy becomes less efficient. Markets cease to function, and just in general, the entire society becomes poorer. So in effect, government action distorts and in some cases obliterates the price system. Economist Ludwig von Mises explained it this way: "Prices are by definition determined by people's buying and selling or abstention from buying and selling. They must not be confused with fiats issued by governments or other agencies enforcing their orders by an apparatus of coercion and compulsion." He went on, he said, "Prices are a market phenomenon. They are generated by the market process and are the pith of the market economy. There is no such thing as prices outside of the market. Prices cannot be constructed synthetically, as it were. Prices cannot be constructed synthetically. And yet that's exactly what government people try to do when they get involved in price controls, price fixing, and indeed setting interest rates. So, given this reality, given the importance of prices, given their role in our economic system, why would you want central planners trying to set one of the most important prices in the entire economy, the price of money? I mean, that's the foundation of the entire economy, right? And the results of this are exactly what you would expect. Central bank interest rate manipulation has distorted the economy. It's incentivized unsustainable levels of debt. It's driven boom bust cycles, and generally, it's wreaked havoc on the operation of the economy. So this brings us back to kind of the original question: should the Fed cut rates right now? Well, now that we understand the nature of interest rates, it should be clear why we can't answer the question. Not even the brain trust at the Fed can process and possess all of the information necessary to accurately set any price, much less the price of money. So we're asking the wrong question. And, this is the difficulty that faces central planners at any level, right? Economist Friedrich Hayek called it the knowledge problem. And this is essentially the argument that in any complex economy, no single individual or central authority can possibly possess all of the relevant information necessary to make optimal economic decisions. I mean, think about all of the information that's out there. Think about all of the things, just in terms of the economy, that there is to know. Nobody can know all of that. It's impossible, right? That's the knowledge problem in a nutshell. Nobody can know. We don't have that capacity. And every person comes at things in their own unique insights with their own preferences and local information, right? So we're all different. That makes this kind of planning even more difficult. You can't plan that. Second, information is subjective and context dependent. You have a piece of data, you have to put it in context. That's hard to do because think about how big the context is in a market economy. I think about this a lot because I'm guilty of this. I'll fixate on certain things. I'm fixating on interest rates right now, right? And yet there are bajillions of other things that are impacting the economy besides interest rates. So you have to put information about interest rates into that context. Very, very difficult to do. It's really hard to aggregate and standardize all of this information. And third, economic dynamics and their interplay are always shifting, right? Oftentimes, things change very quickly. It's impossible for a handful of minds to track all of that, much less respond to those changes in any kind of timely manner. So you can see the impact of the knowledge problem. It makes central planning virtually impossible. And it's why central planning always ends up in a disaster. Unfortunately for us, there's no shortage of hubris. So there's always somebody waiting out there in the wings convinced that they're going to get the central planning right this time, right? It's like the old joke. Well, look at how many times socialism has failed. Well, they just haven't done it the right way yet. Well, that person's not out there because of the very nature of central planning. They're not going to get it right next time. And anyway, the point is, planning interest rates is as dumb as planning iPhone prices. Now, of course, central planners, they're going to centrally plan. So we all have to live in their world. So let's look at the interest rate question from that perspective. Now, I still can't tell you whether or not they should go up or down or remain the same, but we can look at how the current interest rate environment compares with the past. And we can kind of predict, knowing the nature of the way central planners think, the way Fed officials think, their past actions, we can kind of get a sense for where they might be going. And this information can help us as investors make good decisions about how we allocate our resources and how we set up our portfolio and how precious metals can fit into that equation. Now, if you take a chart that shows the trajectory of Federal Reserve interest rate policy, you will see that historically, right now, rates aren't really high. Okay. In fact, the Federal Reserve funds rate peaked just above the level of the 2006 peak, and that was the height of interest rates before the Great Recession. I think it's important to note that the Fed was already cutting rates long before the financial crisis and the 2008 Great Recession really manifested itself, right? They were already cutting rates. So it's kind of like today, right? They got to a peak, they held it there for a little while, they started cutting, and then a pretty good ways into the cutting is when the crisis actually manifested that was caused by the higher interest rates. So that just goes to show that it takes a while for the impact of these things to really work their way through the entirety of the economy. But the point I'm trying to make, and it's kind of hard to do visually, but the point I'm making is that when we peaked out interest rates in this cycle at the peak of the Fed's inflation fight, it was about the same as it was at the peak in 2006. So we weren't exceptionally high. We're not exceptionally high today. It's also interesting if you look at the trajectory of Fed interest rate policy, you're going to notice a general downward ratchet effect in rates over time. Each interest rate peak preceding a bust gets lower and lower as the economy has become more addicted to easy money. So they have to push rates lower during every crisis. So, after the dot-com bust, they didn't go to zero. They went to like 1.5. It stayed around there for a while, but that was really like unprecedentedly low at the time. But then during the Great Recession, we had to go to zero. And, they had to keep rates at zero for almost a decade. And then they had to do quantitative easing because the rate cuts alone weren't enough. And then, of course, we went to the pandemic and they cut rates to zero again. And then they doubled down on quantitative easing. So each time we have a crisis, it takes more and more of the easy money drug, more and more inflation to pull things back up out of the gutter. So, I think that the most notable aspect of the chart, if you look at it for a long term, you go back to look like from 1970 through today, The most notable aspect of this chart is the nearly 10 years, almost a decade of 0% interest rates following the 2008 financial crisis. This is the real outlier, right? That was what was not normal. Having interest rates at zero for that long, we ended up with all of these bonds that for years and years were yielding negative yields, right? Negative interest rates. If you were holding these bonds, you were literally losing money. You weren't even keeping up with inflation at all. You were losing money. And that's not normal, right? However, we have millions of people that work in the financial sphere now who have really never experienced a normal interest rate environment during their careers. They got in around 2008. They don't remember, 20% interest rates when Paul Volcker was around. They imagine that zero is closer to the norm than 5.5%. So the current lowish interest rate environment, lowish, and I'm talking about from a historical perspective, becomes even more apparent if you look at the real yield, so the inflation adjustment yield on the 10-year Treasury. They're about half of the average we saw from the 1980s through about 2010. And that's today. That's with yields back positive. And again, if you look at a chart of that, I'll put a chart of the Treasury yields on the show notes page as well. When you look at that chart, you're going to see that yields were much higher to 2010, then they dropped way down, and then they were negative for a long time, which again was the anomaly. Now, keep in mind that central banks have far less control over interest rates on the long end of the curve. So like your 10-year, your 30-year Treasuries, the Fed really doesn't have much control. They're controlling the rate that they charge other banks to basically park money at the Fed. So it is only one piece of the interest rate equation, but it does tend to have an impact on rates throughout the entire curve. Supply and demand, I think, have a bigger impact on the rates of those long-term bonds. And we're starting to see those yields creeping up and up and up. Interest rates on the long end of the yield are creeping up because there is less and less demand for that government debt. So even so, they're still relatively low from a historical standpoint. So the bottom line, and what I'm trying to drive at here, is that the monetary policy right now remains, from a historical perspective, loose. It has been loose for a long time. The Chicago Fed has what they call the National Financial Conditions Index. It's a metric that kind of shows where are we in terms of the tightness or looseness of money in the economy today. And as of the week ending June 27th, the NFCI stood at minus 0.50. So when you see a negative number, that reflects historically loose financial conditions. We could go back to when the Fed was really aggressively in the inflation fight, when they were pushing interest rates up. The NFCI was actually still negative. So I've tried to make this point. The Fed really was not as aggressive as a lot of people seem to imagine when it comes to the inflation fight. We have a relatively, at least from a historical standpoint, loose financial condition. Now, this is, again, of great significance if you're an investor, right? We're already in what I would argue is an inflationary environment, right? We have historically loose monetary conditions. We still have trillions of dollars that were created during the Great Recession and during the pandemic that are sloshing around out there in the economy. They never wrung that inflation that they created out after the Great Recession. And then they doubled down on it during the pandemic. So I think that there's still a lot of inflation out there, and we're creating more, right? When you understand inflation as money creation and expansion in the money supply, that's been going on for about a year. We saw the money supply bottom out about a year ago, and it's been going up ever since. So the momentum seems to be on the side of making the environment even more inflationary. That being the case, you might want to hold on to your inflation hedge, or if you don't have one, you might want to build one. Because the only thing that can protect you from the next round of monetary depreciation, and it's coming down the pike, is to hold real money, gold and silver. that the federal government can't manipulate and devalue and steal your wealth through inflation. So, we've had kind of this consolidation period, I think, in gold and silver over the last several weeks. Might be a buying opportunity as we see these little dips. But at some point, you're going to want to have that gold and silver inflation hedge. And I personally think that people who are looking at the tariff situation or, the jobs data or whatever it is, they're missing the bigger picture when they're selling their gold, when they're selling their silver. Now, personally, when it comes to, should the Fed cut or should it raise rates? I think the Fed is damned if it does and damned if it doesn't at this point. As I've already mentioned, there's still a tremendous amount of inflation in the system that was created during the Great Recession and the pandemic that's not been wrung out. And now we're seeing this push to pivot back to lower interest rates, which is inherently inflationary when you have a fractional reserve banking system. Anytime you have more loans, more borrowing, it is literally creating money. It is pushing money into the system. That's why the money supply is growing now, right? So, in my opinion, it's logical to hold rates higher, but not for the reasons that you'll hear Powell and company giving, right? I don't think inflation pressures are going to come from tariffs. They're going to come from the money creation, right? They're going to come from artificially low interest rates. And ultimately, it's going to come from more rounds of quantitative easing because here's the ugly reality, folks. At some point, the Fed is going to have to start printing money again to buy U.S. Treasury bonds in order to keep the federal borrowing and spending train rolling down the tracks. We're seeing this drop in demand for U.S. Treasuries. And we're seeing a lot of countries kind of on this de-dollarization track. They're trying to diversify away from dollars and dollar-denominated assets. As this demand for treasuries drops, somebody's got to buy all this debt, right? It is clear that the federal government is not going to cut spending. And by the way, the spending cuts in the big, beautiful bill, there are spending cuts in there, but they aren't really cuts. Like if you actually look at the trajectory of spending, spending keeps going up. Even in those categories where there are cuts, if you actually look at it, spending is still going up. That's because they do what is known as baseline budgeting. What they're calling a cut really is just they're going to spend less than they were originally planning to, right? They're not going to increase spending in those areas as much as they were. But spending in general is still going up from the baseline. Not as fast. So it's not really a cut. So there is no intention. There is no seriousness. If ever there was a time, we have a Republican president, a Republican Senate, and a Republican Congress. If ever there was a time to get serious and deal with this debt problem, it's now. And with the big, beautiful bill, they just proved that they're not willing to do that. So the borrowing is going to continue. The deficits are going to continue. The debt's going to continue to grow. Who's going to buy all of this debt? If the world is not willing to buy U.S. Treasuries, then the Fed is going to have to step in. The Fed is the purchaser of last resort. It's going to be up to the Fed to stick its big fat thumb on the bond market, buy these treasuries, hold them on its balance sheet using quantitative easing, and that is inflationary. It is literally money printing. They're creating money out of thin air to buy these bonds and injecting it into the economy. That's what they did during the pandemic. That's what they did during the Great Recession. And that's, ladies and gentlemen, is why you're paying more for everything. But, on the other hand, Trump and others who want lower interest rates, they can make a good plausible argument as well, right? Given the debt, the higher interest rate environment is cracking the foundation of the economy. We need our easy money drug, and the longer the Fed withholds it, the worse the withdrawals are going to become. So yeah, given the economic environment, when you're piled up with debt, when you become so used to easy money, and it's kind of the grease that kind of keeps this broken, bastardized economy going, well, it makes sense that President Trump and many others want rate cuts. They recognize the issues in the economy and that we need easy money. But that's not healthy. That's not a healthy economy, right? While rates are historically on the loose side, they may well be too tight for the current conditions that have been created by decades of monetary malfeasance to begin with. And then again, we find inflation lurking on the other side of the coin, right? Again, low interest rates are inherently inflationary. They incentivize borrowing. I just mentioned this, but I think it's important. Given the fractional reserve nature of the banking system, new loans mean new money injected into the economy. It's the definition of inflation. And I've mentioned this already. The money supply has been increasing for over a year. So we have inflation now. We're not seeing it manifesting in the CPI. But just because the CPI is cool doesn't mean there's not inflation. You have to look at the money supply. And of course, the drug pusher, the Fed, it's not going to let the addict die. So again, it's entirely predictable that the Fed is going to go back to easy money. It's just a matter of time. Now, the most likely scenario, in my view, is that a crisis caused by the debt and the malinvestments, and this was created by the monetary malfeasance during the Great Recession and the pandemic. We still haven't reckoned with that. That's going to manifest. We're going to have a crash. And at that point, the Fed's going to cut to zero and do the quantitative easing thing, because that's what it does. That's the fork it knows. And, keep in mind that an economy addicted to easy money needs bigger and bigger fixes to maintain the high. And this is why we've seen more and more extreme monetary policy during each subsequent economic downturn. But for now, I would argue that the Fed's inaction is exactly what you would expect given the catch-22 it finds itself in. It simultaneously needs to cut rates to prop up the easy money addicted economy, and it needs to hold rates steady or maybe even raise them to keep price inflation at bay. The bottom line is that the Federal Reserve's monetary malfeasance has completely distorted the economy. We should not have a central bank setting interest rates, setting the price of money. Because we do, this is the mess we have. The central bank has squeezed itself between a rock and a hard place, and the reality is there isn't a good choice. Because really what you're looking at is a choice between economic malaise and inflation. And we're probably going to get both. I think stagflation is a very likely scenario as we move into the future. And that, ladies and gentlemen, is why you need real money. It's why you need gold and silver. Because the Federal Reserve can print money, and it can manipulate interest rates, and it can mess with the money supply. But gold and silver, that's something that the market is in control of. And gold and silver, the price is going to go up as inflation goes up. That's why it's an inflation hedge. Gold and silver have been money for thousands of years. They're going to continue to be money into the future. They're good, sound money. You want to hold that. You don't want to expose yourself to a bunch of these fiat dollars that they're just devaluing and manipulating day after day after day after day. It's almost like you've got your dollars in a campfire and they're just burning up. So today is a perfect time to call 800-800-1865. That's 800-800-1865. Talk to a Money Metals, precious metals specialist today. They can help you figure out how gold and silver will fit into your portfolio, how to get you started. If you're somebody who's thinking, I just don't have thousands of dollars to put into gold or silver right now, you can build your position over time. We have a program here at Money Metals where you can get on an installment plan. Little as $100 a month, you can begin to build a gold and silver portfolio. So give them a call today. If you don't want to talk on the phone, you don't have to. You can go to moneymetals.com, chat with a precious metals specialist online in a chat, or if you know what you want, you can just go to moneymetals.com and purchase gold and silver right there. It's a quick, easy process, and you will see everything right there at the website. So do that today. Do not wait, because I'm telling you, ladies and gentlemen, this is the fate of our money, right? We've got a central bank that should not be price fixing, but is absolutely intent on price fixing. And everybody thinks the price fixing is going to be great. And I tell you, it's not, no matter what they do, because central planning always fails. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Really appreciate you listening to the show. I know there's a lot of things vying for your attention out there. Thank you for spending a little bit of time with me. If you like the show, you can do me one favor. So all I ask of you, go give us a good review on your podcasting platform. Give us those 5 stars. Give us those thumbs up. Crush those like buttons. Share the episode. That helps us grow the show, and we would really appreciate your help with that. Again, thank you so much for listening, and I will be back again to talk to you next week.